Welcome back to the home of the world's smartest money. This is the insuranceaum.com podcast. Insurance asset management is unlike any other investment discipline. That's why, in collaboration with the institutes, we developed the Chartered Insurance Investment Manager, or CIAM, designation, the new standard for insurance investment professionals. CIAM is the first designation designed specifically for insurance asset management, delivering practical, real-world education for both early career professionals building their foundation and experienced leaders looking to deepen their practice. All CIAM courses are 100% online and designed to fit into your busy professional schedules. To learn more about CIAM or to enroll, visit theinstitutes.org/designations or reach out to sales@theinstitutes.org. Welcome to another edition of the insuranceaum.com podcast.
Commercial real estate investors like to buy everything when it feels really good and sell everything when it feels really bad.
So many people were looking for a recession, and that just hasn't happened.
In the last 18 to 24 months, we've created more data than all of humanity before it.
We're coming into 2026 on pretty solid footing.
My name's Stewart Foley. I'll be your host. Hey, welcome back to the home of the world's smartest money on the insuranceaum.com podcast. My name's Stewart Foley. I'll be your host, and we're thrilled to have you along today. Today is a very interesting podcast. It's on global fixed income and insurance portfolios. Today, I'm joined by Brendan Murphy, CFA, Head of Fixed Income North America at Insight Investments, and Jim Kaniclides, CFA, Head of U.S. Insurance and Senior Portfolio Manager. Brendan oversees implementation across U.S. Core Plus, multi-sector rates, mortgages, insurance, and investment-grade strategies, and serves as lead portfolio manager for the global aggregate strategy. Jim leads portfolio management and solutions design for Insight's U.S. insurance clients and has spent decades focused specifically on insurance balance sheet management. Brendan, Jim, welcome to the podcast.
Thank you, Stewart. Thanks, Stewart.
We're thrilled to have you, for you to be here. We're looking forward to a great education today on Global Fixed. Before we get going too far, we start them all the same way, which is, can you tell us each where you grew up, what was your high school mascot, and what job would you like to have if not the one you're in today? Jim, we'll start with you.
Sure. I grew up in a little map dot town in Ohio called Ashtabula.
Wow, there you go. I've not heard of that. I have not heard of that town in Ohio.
Not many people have heard of it unless you just sort of drive by it off the highway.
Yeah, no.
High school mascot was a lion. And job I'd like to have, I'm thinking about this a lot more, Stewart, because I think AI is coming for me. So if I had the talent and skill, I think I would own a restaurant.
Wow, there you go. I've owned one. I learned 3 rules. One is, don't get into the restaurant business. And the second one is remember rule number 1. And the third one is remember rule number 2. It was so difficult. I have so much respect for people who have successful restaurants because it is so hard. It is so hard. But anyway, I digress. Brendan, how about you? A hometown high school mascot. What job would you like to have if not this one?
Sure. So my hometown is a small town in Connecticut called Wallingford, Connecticut, which is kind of midway between Hartford and New Haven.
I know Wallingford. There was a go-kart track in Wallingford, a good indoor go-kart track that we would go to in the winter when it was real cold and we couldn't road race. We'd all go down there. And I've been to Wallingford a few different times.
Nice. Yeah, it's a great town. So I grew up in Wallingford, Connecticut. So high school mascot is actually called the Judges. So I went to private school in Wallingford, which is actually more of a boarding school. So that was an interesting experience in and of itself, being a day student at boarding school. But Judges is the nickname. It's a little bit lame, doesn't exactly intimidate fear into the opposition, but so be it. That was our mascot. And then in terms of jobs I'd like to have, and this is, as I get older, I've been thinking this through about things that I could do in my second life. And when I have come in, I've got 3 kids, the youngest of which is just gotten her driver's license. And I'm shocked at how difficult it is to get a driver's license for kids. And I'm like, I think there's a market, at least in Massachusetts, for more driving schools because there seems to be a shortage of instructors and there's all kinds of kids looking to drive. So I think that's my second career if I get the opportunity is running a driving school.
I think there's something to that. And I will say, I believe there are state differences. I believe that I think that best practices in Massachusetts and best practices where I live in Texas are probably somewhat different. So it's,
I can imagine that.
there's a number of reasons why people do not blow the horn and flip you off in Texas. And they don't. And there's good reason for that. But so let's start right off here and talk about the global bond market and framing the opportunity. My question is to Brendan. Let's start with the big picture. When we say global fixed income, what are we really talking about in terms of size, structure, and the opportunity set?
Sure. I mean, it's an interesting one because I think, to be honest, I think U.S. investors, particularly in the fixed income space, are a bit spoiled. And what do I mean by that? I mean, when you look at the U.S. fixed income markets, they're exceptionally deep and diverse in terms of the access you can get to different types of instruments. And when you talk about the U.S. in the context of global, it's interesting that the U.S. is only about 1/3 of the overall global universe, if you will. And when I talk to clients in non-U.S. countries where their domestic fixed income markets are much smaller, their default is to think of global because their domestic markets aren't developed enough, basically, right, to rely on that. So to get proper diversification benefits, right, they think of global as the natural first step. U.S. investors tend to be more skeptical about it, right? They think about fixed income as the safe part of my asset allocation mix. I got a lot of options in the U.S. Why would I ever want to do global? Isn't that riskier, quote unquote, right? And do I really want to take more risk with my fixed income component? And the reality is, what we found is if you introduce that diversification level, remember, you saw this particularly in years like 2021 and 22, when the Fed was raising rates aggressively, that to be diversified in terms of your central bank exposure, if you will, and have exposure more globally really helped from a total return perspective. And a common sort of misnomer around global is that if you look at particularly developed markets, the US is a relatively high yielder, right, compared to other developed markets. The nuance to it, though, is when you hedge the currency risk associated with places like Europe, Japan, the UK, who have lower nominal yields, you actually pick up a lot of carry by hedging back into the dollar because US short rates are so much higher than in these other countries. So Japan, for example, when you hedge a JGB back into the dollar, you pick up like 300 basis points in terms of carry on that hedge, which is quite significant. So, when people look at a JGB, which a 30-year JGB, which has been in the news recently, 3.41 is what you see on your screen. The reality is on a hedge basis, you get something more like 6.41 when you hedge it back. And when you compare that to what you get in the US, which is about 4.7% today, obviously significant pickup. Different level of risks, right? Different diversification get out of it, but potentially using hedging, which people typically, when they hear hedging, typically think, oh my God, I'm hedging. What's it going to cost me to hedge? And in a lot of cases in global markets, you can hedge, reduce risk, and actually increase yield, increase return.
It's interesting because I was thinking the way you were talking about, which is hedging costs me money. And that's an interesting point that hedging in this case is positive carry and not a little bit. I mean, 300 basis points is like, when the basis is 300 basis points, it's a lot, like on a relative basis, right? And on top of the comment, I've got a question for you. So I kind of had the same perception about the U.S., that the U.S. fixed income market is significantly more developed in terms of its diversification and different things that can be securitized. But that's a fairly limited, not on much data. How would you compare the evolution of fixed income markets in the U.S. versus others, if you can do it with big crayons?
Well, I think the reality is, particularly in the credit space, there's two things that are going to drive supply in debt markets. And one is the sovereign dynamics, which are frankly abysmal for everyone. Pretty much, right? Everyone's issued more sovereign debt, right? So that's becoming bigger parts of those universes, and those governments need to figure out how to fund that. But the insatiable demand has been on the credit side, and that's where I'd say part of it is the way that the financing markets work, i.e., in the U.S., corporations and entities are just more comfortable securing financing through the bond markets, right? Whereas they're using interbank channels in Europe and other places, and maybe something different in places like Asia. So the U.S. has definitely been at the forefront from an issuance perspective and a diversification perspective, and that buyer base has moved along with that. So, I don't really see that changing anytime in the near future, to be honest with you. I think the US is always going to be the leader from the credit perspective. But again, that diversification can work in multiple ways. One is your credit diversification, where by taking advantage of some of those opportunities in Australia, Europe, UK, whatever, right, you're diversifying entities, but you can also diversify your interest rate risk. And that's important in a world where central banks are going to be correlated, but potentially some zigging when others are zagging. Right? When the US is hiking, maybe Japan's not. Maybe they're cutting, or maybe they're staying put. Or conversely, if there's a big slowdown, the US may be cutting more aggressively, right, than other central banks. So that diversification of rate exposure and credit exposure should be thought of, I think, when you think about the holistic allocation.
That's super helpful. Thank you. So let's kind of the next item up for bid here is how insurers actually invest globally. And this is to you, Jim. How much of U.S. insurers' assets are actually invested outside the U.S. today?
It's a really small amount, Stuart. If we look at data that the NAIC aggregates and reports, it's only about 3% of invested assets. So it's tiny. Looking deeper below that, now that's all foreign investments. So looking deeper down to the next level, most of that is fixed income, about 85% of that. And then if we dig down below that, most of that is actually in corporate bonds. So this gets to sort of the thirst for yield that insurers have, and about 85% of the fixed income is in corporate bonds. The other interesting note is that most of that is investment grade. So more than 90% of that fixed income is investment grade bonds. So, they're not looking to high yield in large parts. They're not looking to add what I would say add credit risk with respect to, we think about public ratings or capital charges. They're doing all of this within the context of what I would consider is kind of a core allocation, but it's really small. So there's a big opportunity we think, to add exposure.
And if I combine your number with Brendan's, 97% of the insurance market is invested in 1/3 of the global possible bond market, right? Where I'm coming from is you said that the U.S. is something like 1/3 of the global market. And then, Jim's saying that only 3% of it's invested outside the U.S. So I'm kind of putting some numbers together there. But am I kind of halfway right there? Our audience is only hoping for me to be halfway right, by the way.
Yeah, no,
Yeah.
100%.
Okay.
I think you're 100% right.
Okay. Wow. Okay. All right. Listen, I'm on a roll. I'm going to keep going. So let's talk a little bit about strategies for accessing global markets. And this one's really to Brendan. How are insurers how can I invest if I'm a CIO and I want to gain some global exposure? And to your point, like outside the U.S., the global market is actually thought of as de-risking, right? And in the U.S., we don't necessarily think about it that way. So if I'm an insurer, how do I do it?
Yeah, so pretty much, all the typical flavors you'd get within US fixed income, we can offer in a global format. So for us, the main product would be global aggregate, for example. So we actually run things that we call global core plus, similar to what you'd hear US core plus. And it's really very similar, just using the global aggregate as an index instead of the US aggregate. And that same 1/3, 2/3 ratio holds true. So you get global ag, you get everything that's in the US ag, but then you also get 2/3 of exposure to these other sovereigns and credit markets in the developed market space. It's got a similar investment grade only, right? Triple B minus or better. And it looks and smells very much like a US core plus portfolio when you hedge that currency risk, except you have much bigger diversification potentially bigger alpha opportunities for an active manager that's managing in that space. And then the corollaries are all going to be the same, right? If you want something that's global securitized or global high yield, global credit is a popular product that we have as well, where it's primarily US and European investment grade. So you can essentially take just about any of the typical products you'd find in the US space, redefine them as global. You're still going to have, the US is probably the biggest portion of those indices, but much more diversification by expanding the universe to global in nature.
That's super helpful. Thank you. So let's turn to yield and relative value. So, and this one, I'm coming back to you, Brendan, if you will. How do global yields compare to U.S. bonds today across developed and emerging markets and across government, corporate, and high yield sectors? And here's a fact check for me. I remember I was running money during the European debt crisis, and Greek debt was forget it. Nobody wanted it. Last time I checked, it traded inside of U.S. Treasuries. Talk to us about the global yields in the U.S. bond market today. Can you get us current on what those relationships actually are?
Sure, happy to. And it obviously is going to vary through time, right? So there's not in any given cycle, you're going to see rates move 100 basis points high, 100 basis points low, probably relative to each other, depending on where they are in their interest rate cycle, monetary policy cycle. So if you look at the current environment, you have US 10-year treasuries around 4%. Germany is about 275. UK is a little bit higher at 4.4%. Japan's a bit lower at 2.1%. Australia is about 470, so a bit higher than the US. So the US is sort of in the middle to higher end of that range. Now, this is where it gets a little confusing, is just on that hedge component. So Japan, which I told you, 2.1% for the 10-year. But again, when you hedge that Japanese bond back, you're picking up 3%. Why are you picking up 3%? Because the short rates in Japan and the US are 3% apart, right? So in other words, Japan's closer to 1, the US is closer to 4, right, in terms of short rates. So when I hedge it back, I pick up that 3. So that means the JGB at 2.1 plus the 3%, I get a 5.1 hedged yield. Decent pickup, almost 100 basis points higher than I get in the US. And people typically be like, well, how does that work? Why is that? And it's really all about the shapes of the yield curves. And the Japanese yield curve is much steeper than the US yield curve. So you hedge at the short end of the curve, and then you lock in the investment in the 10-year and the 30-year or further out the curve. So it really depends through time. It really depends what the hedging costs are. The hedging costs can move. If the Fed is cutting rates aggressively, that you'll get that hedge right now, but you may not be earning that a year from now if they cut rates aggressively over the course of the next year. Vice versa, if Japan's raising rates aggressively, it'll go against you. So the beauty of it is, from an active standpoint, right, we have all these different levers that we can pull to try to figure out where central banks are in the cycle to manage around central banks that are hiking aggressively, or to avoid them in portfolios, right, and favor ones that are cutting or much easier in terms of their monetary policy.
Yeah, it's interesting. It's the one thing we can always guarantee, right, Brendan, is change, right? That's
right.
I mean, for most of us, it keeps you in the game for all these years, right? Is I don't know what's going to happen tomorrow, but I can tell you it's not going to be the same as today. And for however big those events are or small, it's going to impact the markets one way or the other. And it just happens. It's just the way it is.
I think, Stuart, if you think about it simplistically, these are all developed markets that have reasonable correlation, right? The economies are relatively synced. The central banks are somewhat synced, right? They're experiencing similar growth and inflation challenges, with some exceptions, but the magnitude's different and the response function is going to be different, right? Certain central banks may be more proactively tackling inflation, others may be less aggressive, right? So that creates the relative value dynamics that offer active managers potential value.
Yeah, that's perfect. So thank you so much. All right, so let's shift over to portfolio construction for insurers, and this one's going to Jim. Jim, how should insurers think about incorporating global bonds into their portfolios?
Stuart, you know from your podcast topics and the trends in that insurers are looking for yield. And anything private has been the hot topic, and we've seen real strong growth in those asset classes. But they're really looking, They look for yield anywhere they can get it. And, 10 years ago within the US fixed income markets, there were pockets of illiquidity, I would say, that insurers were happy to take advantage of. Things like taxable municipal bonds, where, high quality, but you could get paid a little bit more for illiquidity. Insurers, I think now one of the things within investment grade allocations insurers are doing is pushing into structured markets and making bigger allocations there. And they're happy to accept and have to deal with the complexity and the modeling risk in those. With global, it's still an investment grade asset class. So there aren't higher risk based capital charges than they're getting within their investment grade US fixed income portfolios. So we do think it fits within core allocation. It's not what we would call, or many would call, a risk allocation that requires higher capital charges. So you can do this within your core allocation, and you're accepting, if with respect to accounting treatment, which we haven't talked about, but you're accepting a bit more complexity with accounting treatment. Brendan's talked about hedging the exposure and the hedged yields. Insurers can get hedged accounting treatment for it, which is more favorable for them, but there is a bit more work involved to do that. Now, I think most insurance accounting vendors can support that, so I don't think that's a big hurdle. But I would say this is just another way for U.S. insurers to think about opportunities to add yield without having to push out into more risk asset classes.
Yeah, it makes sense. And I've got my next question really comes from a LinkedIn poll that I did, which is asking our audience, what question would they like me to add? And this is it. Either one of you or both. What scenario would create headwinds for a global fixed income allocation for an insurance portfolio? In other words, give me the scenario where I decide to invest globally and it doesn't work out for me. What has to happen?
Sure. So from my perspective, the main thing is the rate risk, right? So I referenced the 21-22 environment because that was one where global worked quite well. It was one where you had a super aggressive Fed hiking rates. Other central banks, mainly Asian ones, weren't doing anything essentially, right? So that balance, that diversification really helped you in a rising rate environment. Where it could go against you on a relative basis is the converse of that. One where, let's say, we're facing a global recession, the Fed is cutting rates aggressively. For whatever reason, we're going back to 1% interest rates on the front end. That's one where the US is probably going to be a really good performer in a global context compared to some of these other markets that don't need to cut as much because rates are already lower. And that's not necessarily a bad environment from a total return perspective. You'll do well. You just would have been better off probably if you were in the US, relatively speaking. So that'd be the one that I'd point to.
That's super helpful. All right, Jim, last one here before we got a couple fun ones for you, but are there other considerations that insurers ought to keep in mind when they're investing globally?
Yeah, Stuart, I mentioned the accounting one. I think that frightens off some investors. I think they don't understand the hedged yields that Brendan explained. There is, as I mentioned, some additional accounting complexity to it, but I think, in our world today, that shouldn't be a big hurdle. There are state statutory limits on foreign exposure, but those generally range from 10 to 20%, depending on the state. So there's plenty of room to add based on the numbers we saw from the NAIC with such a low exposure in the aggregate. And there are also, some states also have limits on individual countries beneath that aggregate exposure of 10 to 20%. So I think those are some of the considerations for insurance companies. But as I've said, I think those are easily surmountable and, make this, I think, make a lot of sense for their core allocations.
It's been super helpful and had a great education today on global fixed income. I managed to learn a few things along the way here too, and which is, always helpful. I mean, one of the things that we did, we put together Kayam, is we had to go find 40 subject matter experts because nobody knows the entire landscape of this business. And every time I have an asset class specialist or some subject matter expert on, I get to have a little bit more education too. So I want to say thank you to both of you. The one question that we've been asking of late, it really attempts to get at the culture at Inside Investment. And it goes something like this. What characteristics, and not only for your time now, but also you've both been at other places and you've been at this for a minute. What characteristics do you look for when you're adding to members of your team? Brendan, I'll take this one to you, and just what characteristics are you looking for when you're interviewing?
So I'll start with a little bit on inside investment, which is what I would describe as a specialist fixed income manager, right? So we only do fixed income. It's very much a specialist model. So we're looking for deep subject matter experts. Jim would be one for insurance, right? I'd be one for global, whether it's corporate credit, securitized markets, right? We're looking for deep subject matter experts that go as deep as possible and understand everything there is to know about those worlds. Now, that's a great model in and of itself. I think the challenge of it, and this is what I look for, is obviously we want subject matter experts, but we also want subject matter experts that can work across teams. I think if you create that specialist model too far, you end up with a bunch of silos that do well, right, with someone who wants a single sector type product. But when you're trying to create multi-sector products and you need that cooperation, collaboration, being able to work across teams, that's something that I greatly value, particularly from my oversight function within the firm. So I want someone that is going to be a deep subject matter expert, but is also interested in how other teams are put together and willing to work with them, right, to create multi-sector products which are going to resonate with clients and not just sort of in their own bubble, working in their own space. So it's that delicate balance between being a deep subject matter expert and a team player, team collaborator that I'm trying to identify.
That's awesome. All right, when we have two guests, our last question goes like this. You can have dinner with up to 4 people, including the two of you. So you each get one guest. Dinner's on us. I always say that. We have a new owner, and nobody's yelled at me yet. But in this hypothetical dinner, you can have one guest. It can be anyone, alive or dead. So I went to Brendan first last time. Jim, I'll come to you. Who would you most like to have dinner with, alive or dead?
Well, Stewart, you kind of ruined my pick.
Oh,
but
no.
I'm going to go. I'm going to go with it anyways, and it's probably someone given your locale. My guest would be Aaron Franklin. Do you know Aaron Franklin?
No.
Aaron Franklin runs what many believe and has been rated as well as the top-rated barbecue joint in the
there
U.S.
you go.
So this, again, along the lines of needing a second career, but I also took his master class on barbecue, and mine doesn't turn out like his. I think he left a few things out that I'd like to talk to him about.
That's interesting because there's a place near us that got voted best barbecue in Texas. And I'll tell you what, it is some stiff competition down here. There's a lot of folks that really take it seriously. But it's an interesting one. That's from my perspective, super cool. All right, Brendan, how about you? Who's joining Jim, the king of all barbecue, and you? Who's the lucky fourth?
All right, so I'm going to start with this. I'm a bond nerd, number one, but I'm a baseball nerd, number two, is what I'll say. So, and I'm a big believer in the baseball as a metaphor for life thing, if you will, right? This idea that being successful, is only being successful 1/3 of the time is you're the greatest player ever, and that 2/3 of the time you're failing. The fact that the seasons are so long and that they're a bear to go through, the nuance, all the subtleties that go into it. My daughter and I, actually, the same daughter I referenced with driving lessons, we're on a mission to see every Major League Baseball park in the U.S., which has been
cool.
a really fun thing to do, an educational thing to do. And we have about 6 or 7 more to go. So all that said, right, I'm setting up for my pick is David Ortiz. Why
wow.
David Ortiz? A, because I'm in Boston, right, and I think he's a tremendous player. B, never have I seen a more clutch player. That's why I'd like to have dinner with him, to meet him, is just to understand how you can be so clutch in a sport like that, right, which is so built around failure. That's always super impressed me. And he just seems like a super fun guy that I think would enjoy barbecue as well. Would be my guest, Jim.
Yeah.
So I think we'd have a great time.
I got to think that you better go on the family plan there. I mean, there's going to be some food consumed before.
Well, we're not paying for it, Stewart.
That's
so,
right. Yeah, doggone it. That was I kind of hung myself there, didn't I? So, listen, thanks so much for being on. I really appreciate you both. And, certainly we've benefited from your expertise. So thanks so much for being on.
Thank you, Stewart.
Thanks, Stewart.
We've been joined today by Brendan Murphy, CFA, head of fixed income at North America at Insight Investments, and Jim Kaniclides, CFA, head of U.S. insurance and senior portfolio manager. If you like what we're both at Insight Investments, sorry, I should have mentioned that. If you like what we're doing, please rate us and review us on Apple Podcasts, Spotify, or wherever you listen to your favorite shows. It means a lot to us. We look at the ratings. We appreciate the comments, and in all sincerity, it matters. And we also, this one is not a video podcast, but oftentimes they are. And you can catch it on our YouTube channel at Insurance AUM Community. My name's Stewart Foley. I've been your host. This is the home of the world's smartest money at insuranceaum.com.